We started the show today telling you that the TSX hit an all-time high in Thursday's trading session, and some wouldn't be surprised if some of those gains continue to roll along. There's a look at what's been happening with that chart, up more than 60% since the March lows. John Zechner has been tracking it all. He's with Zechner Associates and joins us now with his take on that record run. John, nice to see you. What have you made of this strong start to the year for the TSX?
Hey, John, Happy New Year. Yeah, no, absolutely. They have broken through the record, and it makes sense. I mean, what was holding back the Canadian market really was the fact that the financials and energy in particular, and some materials were underperforming a lot of last year. As you know, it was more the stay-at-home trade, some of the consumer stocks and the technology, which are more predominant in the U.S. market that carry sort of the NASDAQ and those indices to new highs. So, yeah, we're playing a bit of catch-up because the cyclical move, or call it the reflation trade, is back on now. And it probably got a boost in the past few days with obviously what happened with the Senate races in Georgia and the fact that, all three, the Democrats control all three levels of government now and probably put more stimulus spending in place. So a lot of that is sort of getting this reflation trade going. You can see the bond yields, the 10-year bond yield in the U.S. as well popped through 1%, which was a key level that a lot of people were watching. So you've got a bit of this belief back on that, certainly you're going to have a more robust year economically, despite what the short-term sort of risks are in terms of the COVID and further lockdowns, et cetera. And the market's pricing across the valley and looking to this recovery trade.
So you're an investor who's comfortable buying stocks. You're also comfortable shorting stocks. At this stage of the game, where are you placing your bets? Do you think the TSX could continue to rally?
Yeah, John, in terms of things like what I do in our hedge fund, where we do longs and shorts, I think more of our long positions are what we call the value or the sort of the recovery trade, the reflation trade right now. We're sort of, we added to financials a while ago. We added to energy. We added to base metals, to industrials. The industrial production side of the economy, clearly is turning around. We're seeing, better economic numbers out of Europe, some of these places. And where we're sort of probably adding a few shorts is some of the areas that were completely levitated by low interest rates, ultra low interest rates, the growth sectors of the market. And it's a bit of a tough bet right now to go against any sector of the market because there's still speculation there. But, I think you're going to get a bit of unwinding of this great interest rate trade we've seen for a while. And it's somewhat interesting, John, in the way that what could be the downfall of this market in the short term, and we'll have a correction at some point, could be what we're all hoping for and believing right now is a recovery. Because if you actually get a recovery, if you turn around and we're at 4 to 5% growth in the U.S. in the back half of the year, in Canada, and you've got an inflation rate running around 3%, there's no way in the world you can argue for zero interest rates continuing, and that's supported the valuations of a lot of these hyper growth stocks. I mean, that's why Bitcoin and a lot of other things have soared on the speculation. So it's sort of a bit of a dilemma from that point of view.
Yeah. Does it feel like a new market? I mean, there are obviously a lot of people who literally have been at home looking at the stock market as a place to make some money in a time where, there are fewer jobs. We're certainly going to be talking about that coming up in the program. Does the market feel different? The people who are participating and the way by which they're investing?
Yeah, John, you're absolutely right on that one. I mean, you can take it from the Robinhood accounts in the U.S. and all of these things. The people, of all the payments that were made by government, so much support out there. I mean, the saving rates are quite high. People are flush with cash. Companies are sort of flush with cash. And, they can't really, haven't been plugging it into the real economy. They haven't been spending and they haven't been, going traveling or anything like that. And instead, they invested. You were talking to David Rosenberg yesterday, and, I agree with some of the things that David is saying is when you have a little bit of growth, I mean, there's all this money creation that we've seen, this massive money creation has to go somewhere. And the absence of going into the real economy sort of goes into the financial economy or goes into the speculative areas of the stock market. So, we have seen, you can't argue that there's not a bit of a speculative binge going on. And that that worries me to a degree. But on the other hand, we are looking at it. We did get an economic reset last year. I mean, we had the fastest recession ever, the worst downturn, and now we're sort of building for some growth going forward. So the way in my mind to play it is that you've got to stay invested, but look for more the valuation. Be wary of that. Be wary of companies that are supported by continuing zero interest rates, and beware of excessive valuations. Those do matter in the end. They mattered in 99, 2000. I think they'll matter 20 years later.
Helpful context as always, Mr. Zechner. We do appreciate your time, and you have yourself a great weekend. That's John Zechner of Zechner Associates joining us with his take on that record run for the Canadian market.